Hi everyone. You know, the thing about this video is I got caught up about a year ago or more. My friend Alex said, hey, you should keep the backgrounds interesting. And I'm like, okay, so now I have to go out in Times Square or whatever. And this week I was like, oh God, I'm going to Madison Square Garden to watch the Knicks against the Pelicans with my son. We had our birthday, we share a birthday, we had it last week. And I was like, you know, it'd be a funny place to record the video from. So the video, which is meant to go on a Monday, generally speaking, you know, got delayed to the Tuesday night game. And then I'm sitting in Madison Square Garden. I'm like, what the hell am I thinking? There's absolutely no way you can record an oil video in the middle of Madison Square Garden. So anyway, I'm a couple of days late and it's been busy. One of the first things that came up this week was just as you're stumbling through full year results, which is always a long and arduous process, it just is very drawn out. And of course you get the 10K filings, and it was in the 10K filing that the week took a bit of a turn because suddenly HES stock was trading off 3%, and it's always fascinating because these machines somehow scrape the 10K, work out that there's a paragraph in the 10K that pertains to the Starbrook block and sells off HES immediately, and we're just, you know, trying to open the PDF as humans. But of course, there was a key paragraph in there, which was a left field surprise, negative surprise to the Chevron HES deal, which is the Exxon CNOOC, quite a pair of partners there to be calling you out legally, claiming preemption rights in the all-important Starbrook block. And of course, that has the potential to delay the deal. There was a lot of speculation because I have clients, and you're welcome to become a client, by the way. It's an open market for Sankey Research. If you can afford to, you got to pay to play. So contact me if you want to sign up. It's paul@sankeyresearch.com. But anyway, you know, I have merger arb clients, people who just trade the spreads on these deals, and they only call me when there's deals. Now, of course, there's been a lot of deals in oil, but on the other hand, they haven't been at wild premiums or very controversial. But this Chevron HES has become a doozy because there isn't an obvious precedent for claiming a corporate deal would trigger a preemption right. But of course, there is some precedent. And one client who knows Exxon very deeply was highlighting to me that Lee Raymond had got BP over a barrel when it was trying to buy Arco, and made the argument that the North Field gas cap would give potentially BP monopoly control over the North Field. And in order to get the deal done, Lee Raymond got the gas cap essentially given to him by John Brown at BP in order to get through the deal. So I think Exxon's trying to extract its pound of flesh, and knowing that Mike Wirth, the CEO of Chevron, firstly is more than keen to do this HES deal. HES is keen to do this deal. And secondly, is a man who knows how to play the prisoner's dilemma. I could see a deal being made between Exxon and Chevron here, but we'll see. They say that there's constructive discussions, which in big oil terms indicates to me that they're saying there will be an agreement. But of course, you're reading between the lines. The old line I used to like was, we made a significant oil discovery, which in the good old days meant 500 million barrels. That was the sort of rule of thumb. And I think the fact that Chevron in their 10K, we're talking about constructive discussion, is not an unmeaningful word, if that's the thing. So anyway, that's that. In the meantime, of course, we've had a lot of results coming through, and we just sent out a note actually covering a few of them, and it was 10 companies and 10 recommendations. One of the ones that highlighted, there was a lack of interest on EOG going into EOG's results, and I thought they might put in a sleeper winner result because we've seen quite a lot of divergence between company performance through these results, essentially pertaining to the extent to which they've cut capex and issued growth. And the companies that have not done this have been punished, which is the way it used to be with refining until the refiners all got disciplined and fully consolidated the industry and all made much, much better returns. I was interested by a graph shown by Crude Chronicles, who's a great follow on Substack, showing how Exxon's returns in refining have now gone past their returns. And on a sustained basis, we're talking in upstream. So the downstream now makes more than upstream. And you could take that to Chevron, actually, because they divested a lot of their downstream on the basis that it would not be a profitable business or a good business relative to upstream going forward. But of course, by all the companies doing that, it became by definition a good business. And that's what we're trying to get these US E&Ps to do, and say, look, if you all apply individual capital discipline, you're going to be in a much better place as a group. But of course, that's the prisoner's dilemma. Anyway, EOG, I was hoping would come out, and I didn't hype this or write about it actually, but I was just keeping an eye on EOG because no one was talking about it, and I had wondered whether or not they might pull a positive rabbit out of the hat. But actually, they pulled a, I don't know, wet handkerchief or something, because essentially they raised their capex became more gassy in the process. So their total volumes are growing at 7%, oil volumes less than that. So people worry that EOG is becoming gassier as they worry about the rest of the E&Ps becoming gassier. And in the process, essentially raised their capex. So EOG got fairly punished, and I think is, back in the doldrums here. Now, the issue, and people highlighted to me that Ezra Yacob, the CEO, was talking about a chart of mine, which is oil share of the S&P versus oil share of the S&P 500 earnings. He said it's about 10% of the earnings, 5% of the market. It's not quite right. It's actually deteriorated and is now more like 7% of the earnings and 4% of the market. But of course, if you've got increasing gassiness into a gas tape that looks appalling, because we hate natural gas so much that we now pretty much hate natural gas for 2025 here. The reality is that the market's going to hate that marginal rate of change, and it's taken the EOG from a premium multiple to an inline multiple. And I think the fear is here that the market may want to see it at a discount multiple before it wants to buy it. EOG, by the way, is an outstanding company. It has the best returns of any of these E&Ps. But of course, at the margin, that's deteriorating, and that becomes all important in the opposite way that, for example, Nvidia's constantly rising returns. The market can just pay more and more and more for that until there's demonstrable evidence that their returns and growth are not rising. And we're not at that phase yet. Nvidia blew the doors off the room in terms of its results. So with EOG, even though it's an excellent company with very high returns, has the strongest corporate culture of any company I've ever covered. It's fantastic, but at the margin, it's deteriorating. And of course, that's costing it on the multiple. We've seen what that's like for Devon over the past year. Once the multiple starts to contract because of concerns, with a lot of chatter around Devon making acquisitions, it seems to always be the bridesmaid in all these deals that are being announced. Of course, what you get is multiple deterioration. That's very hard to fight. Now, Devon may have stabilized here because the multiples become sufficiently beaten down and the company's operational performance is sufficiently good. Having said that, the overhang of an acquisition has not been talked down on the call here, and Devon will continue to have an overhang of what are they going to do from a corporate strategy point of view. Now, of course, Marathon Oil, which we like and we think the results were good, continues simply to buy back a fixed amount of its cash flow every quarter and is crushing its share count. And it doesn't seem to come up as a buyer in every asset sale. And so I think, Marathon, if we want to run oil here, which is looking good and quite lively to us, essentially because Saudi is successfully tightening the market now. And we think Saudi will keep the market in the tightening mode into the middle of year before they decide what to do next. So if we want to buy oil leverage, we like Marathon Oil here, which gets a lot of juice in the way that Marathon Petroleum, the refiner, gets a lot of juice because it's buying back so much stock that if any actual buyers come in outside this company itself, you get tremendous performance from the stock price. So Marathon Oil did well. We like Civitas, which is less well known, but the company's got the Brad Whitmarsh in as IR, and I think they'll be marketing quite hard to get Civitas' name better known. High return play. Colorado, but also stepping into the Permian. We like Cord as well. And of the names that were a bit tougher, PAR announced, refining generally has sold off a bit here on weaker margins than we expected. We thought that downtime in US refining would tighten product markets, rise gasoline prices, and be pressure on crude. And that hasn't happened at all. I don't know what's happened to that one. I had a real whiz on refining call me last night, and he's like, I don't understand what's happening. With this level of utilization in US refining, how can we not be tightening inventories? Well, it must be very weak demand, but the GDP data looks good. You could say that maybe weather across the US has impacted demand here for January, certainly, less so February. But it's still not clear why the refining market hasn't tightened more than it has. And frankly, that's an ongoing head scratcher that borders on a concern. But anyway, PAR and Delek also still struggling to find a way strategically in terms of its corporate actions that it's sort of promised to unlock some of the parts without us being able to really progress the ball for the last 2 years or so, was also a bit of a problem. The standout was our top pick. Yahoo! Doesn't always happen, but Permian Resources put in a great production performance on flat capex, and again, that's a new name, a private equity roll-up. We love the young CEOs there, co-CEOs, and Permian Resources came in good. So in this overall results season, the oil price is acting a little bit better than we thought it would just short term, but generally speaking, we think oil is good to go through June with Saudi in control. Natural gas we absolutely hate. We like Antero within the natural gas space just because of its propane leverage. Propane is doing very well, but everything else we think has a problem into 2025 is our new concern. And then amongst the oil names, we generally like the bigger names, and we're less, willing to back names where there's corporate action uncertainty, which at the moment would be the likes of Devon and Ovintiv, where Marathon Oil to an extent, although we think Marathon through their actions are showing what their corporate activity is going to be, and it's going to be to buy themselves, and that we like. But generally speaking, the oil space we tend towards, I think the boot is back on Exxon's foot here in the short to medium term, but generally we like those big oils, Exxon, Chevron, Conoco, because we're arguing for oil to take a higher share of the S&P 500 when oil's share of the S&P 500 earnings turns, and we're right at that cusp at $82 Brent. If we can get to 85 and towards 90, you're in earnings upgrade mode, and that will be my call to be long the oils into mid-year. All right, have a great week.